So how do you trade? This is all nice and wonderful. How do you trade? How do you take advantage of this volatility? Well, if we said that, well, it's very simple, right? Well, not very simple. I make it sound simple. So you have support 1, right? You have support 2. So we know that 370 has been a good support. It held this week despite all the negative PPI and CPI print, right? And last week. So this is support number 1, this is support 2. Below 362, there is no support. I mean, it could be 350, it could be 340, just depends. But once the support is broken, you know that you need to probably step out of the market, right? Yes, if you're a trader, right? I mean, if you're a long-term investor, you think we're close to the bottom, fine, maybe you don't need to step out of it. But if you're a tactical trader, aggressive trader, below 362, there's really kind of nobody knows. Next level is probably 350. Everybody talks about this, so I'm going to make an assumption that market is going to pause at 350. So S1, S2, right? And then you know that you have R1 and R2, right? That's what everybody on this conference, on this broadcast said. So these are your levels, right? You sell here, right? You sell premium here. You sell out of the money calls. You can, if you think 410, maybe, once we reach 390, maybe it makes sense to sell 410 call spread, 410, 420 call spread. Or any other, if you ask me about Microsoft, I would say, same thing. When spiders reach 390, then you sell call spread on Microsoft or Apple or Rivian or Bitcoin, same thing. You look at ETF, you know that this is your first resistance. We reach this level or getting close to this level, you can sell, if you're very aggressive, you can sell 400 390 call. If you're less aggressive, sell 410, 420 call spread. And you go to probably October, right? Probably October or November, because we said that this level is probably be broken by September or October. That means for the next month or two, we might be trading in this range, right? So this is where you sell 1, and this is when you sell 2, right? Or sell N3, a little bit more aggressive, because I think this level will be broken. So if you sell 390 call when we reach this level, I think you're taking a lot of risk, right? Because if that level is broken, then you would have to repair the trade and roll it up, right? But I think 415, 420 is much better support levels. And same thing, every time market drops to 370, then you sell out of the money put spread, right? Or you buy stock, depending what you're comfortable with, right? So this is where you do buy 1, right? And short term, I wouldn't do very aggressively, but buy 2. Right, this was a good entry level to kind of get a little bit more bullish at these levels. Any questions, right? So that would be the strategy. Obviously, there is a lot of earnings announcements. So one way to take advantage of extra volatility are selling out of the money premium. You have to be careful, like we did Wells Fargo, it's trading against me. But what else we did? So Wells Fargo is one trade. So here I collected 22 cents and it's trading against me 77 cents, right? Because Wells Fargo, again, it's extremely oversold. You have a rally, so you have a situation where the stock is up 7%, where usually it doesn't move more than 5 or 6%, but it's facing overhead resistance. So you do have to be careful. This is why I encourage you to just do one contract on these strategies, right? Because you can have 2 times estimated move, right? Wells Fargo moving 7%. Last time it happened probably 15 years ago. So it can happen. So you have to be careful. I encourage you to do one contract, right? One contract is $4,000. Okay, so now I'm down, $50. Okay, so it's manageable loss. So the same thing with TSM, right? Sold put spread. This trade is going in my favor, right? So I'm should be up 40 cents on TSM trade, and then so it's a law of numbers, right? You can have one trader like Wells Fargo, but then you have TSM, you have JP Morgan, right? Same idea, sold 108 put, sold 116 call. That trade was profitable, and what else we did? And Pepsi, right? So as long as you do one contract and you do multiple of these names, 9 out of 10 trades, would be, historically has been successful, right? 9 out of 10 trades has been historically successful. Liquid names with tight bid-and-ask spread, large cash flow. I mean, you do get caught with these rallies sometimes, so you just have to manage the losing trade, and I'm going to close it, right? I mean, I can wait till Monday, but what if Wells Fargo jumps another, $4, right? Then instead of losing, $1 or 50 cents, I'm going to lose $3. Since I don't know, right? Even though there is a lot of overhead resistance at this level, I'm not going to take a chance and close this trade. So that's one of my favorite strategies. Another one is you can look at the positions QQQ, right? Calendar spread, right? I'm bullish on technology short term, right? I think the market is oversold, so I sold 280 put, right? It's trying to see if I can maybe gain 50%. If the premium drops by 50%, so around $6, maybe close this position. But at the same time, I'm bearish into December, right? Or October, November. So I have, you don't want to be naked 280 put, right? That's $28,000. That's way more than I can afford, or in average small account. So I encourage you to be long and short the market at the same time. So I'm short 280 put, but I'm long 240 put, right? And I'm also long 280 to 60 put spread. This is probably one of my largest positions. Because short term, I think QQQ can continue going higher, right? We can have similar reaction in QQQ, and it looks like 280 has been a strong support. But longer term, I think we're heading lower. So the point I'm trying to make is to have spreads. Probably portfolio neutral, delta neutral portfolio, right? For one long, you have one short position, right? For one long, you have one short position at this point. And the idea is market rallies, you close your long. As the market drops, you close your short.